Hi, everybody. My name's Dominic Smith at the Bureau of Labor Statistics, and I'm one of the co-organizers of this seminar series with Raphael Schunle, who's at Brandeis. Today, we're going to go for about 45 minutes, and Ina is going to be the moderator, and so I'm going to hand this off to her and let her take it away and introduce the speakers.
Thank you, Dominic. Hi again, everyone. So today's webinar will be covering two topics. Our first topic will be on decomposing supply and demand-driven inflation. And the second topic for today will be on average inflation targeting, timing consistency, and intentional ambiguity. And as usual, many special thanks to the organizers, Raphael and Dominic, for putting together this series. Before we get started, let me touch a little bit on a couple of housekeeping items. So as Dominic mentioned, the webinar will be lasting for about 45 minutes. We're going to have a total of two presentations of approximately 15 minutes each, followed by a 10 to 15 minutes Q&A session at the very end. Attendees, they will not have the option to switch on their audio and video, but are more than welcome and invited to write comments or questions in the Q&A space. They can, of course, pose their questions and are very much encouraged to do so during the presentations already and do not have to wait until the very end. I will then select questions to be answered in the Q&A portion of the webinar. The webinar will be live streamed via the CBRA YouTube channel. It will also be recorded and made available on the CBRA website and its YouTube channel right after the event. Without much ado, let me first pass the virtual floor to our first speaker, Adam Hale Shapiro, who is Vice President at the Federal Reserve Bank of San Francisco and will be speaking today about decomposing supply and demand-driven inflation. Adam, whenever you're ready, the virtual stage is yours.
Okay, thank you very much. Let me just share my screen here. Okay. Here we go. Yeah, so thanks for having me, Ina and Dominic. I'm happy to present today. So this is a paper that actually started out as a policy briefing to our President and CEO, Mary Daly, and then eventually turned into a working paper. I just want to say first that any views I express today are not that of the Federal Reserve System or the Federal Reserve Bank of San Francisco. They're of my own only. So, the backbone of economic theory and especially macro theory on inflation is that inflation or even prices deviate from their expected path due to either supply or demand factors. So if you go back to the 1970s and we had that really high inflation episode, there's been lots of papers that discuss what was the root cause of that high inflation. There's been lots of papers talking about the oil supply related disruptions. And then also papers on the demand side saying that the monetary policy was too easy during that period, which led demand to be too high, causing high inflation. And then of course now everybody knows, and this is top of mind obviously at the Federal Reserve is the high inflation that we're experiencing now. And we're seeing more and more papers come out that are trying to tease out, what is the root cause of inflation now. And there's been papers from colleagues of mine at the Federal Reserve Bank of San Francisco talking about all the fiscal stimulus that's been happening, that's been pushing up aggregate demand and hence inflation. And then on the supply side, there's been a lot of papers talking about the tight labor market, which has been, pushing on wages, and obviously all the supply chain disruptions that have been happening across the globe, which have increased shipping costs and trade costs, and then have obviously passed through to goods prices. So this is a top concern to policymakers, obviously. And this is a quote that Jay Powell had in an interview. He said, what the Fed can control is demand. We can't really affect supply with our policies. So the question whether we can execute a soft landing or not may actually depend on factors that we don't control. So all the supply factors, such as all these issues related to to oil supply shocks, for instance, the war in Ukraine, are obviously outside of the Fed's mandate, or the Fed's control, obviously. And also, if inflation now is all being, let's just say hypothetically that inflation was all being due to supply factors. So, that's going to be pushing down output and inflation at the same time. So if the Fed, were to be fighting that inflation by increasing rates, reducing demand, that would just exacerbate the situation and, increase the risk of going into a recession. So, it's crucially important that we understand what's driving inflation. So in this paper, it's a very simple framework which decomposes overall inflation into both supply and demand-driven components. The framework is going to generate two new data series, the supply and demand-driven contributions to PCE inflation. So PCE inflation is the Fed's preferred gauge of inflation. There's also CPI, obviously. And it really boils down to, Econ 101, which I'll just show in a second. So the supply-driven categories are those where prices moved due to a supply surprise, and the demand-driven contribution is those categories in the underlying PCE inflation series that moved either up or down due to a demand surprise. So as I just said, this all boils down to the most simple economics theory that we have, which is just the shape or the slope, I should say, of the supply and demand curves. So what we know, obviously, is that if a supply shock occurs, then we're going to see prices and quantities move in opposite directions. If a demand shock occurs, then what we should observe is prices and quantities move in the same direction as you move up the supply curve. So we're going to dig down into the sectoral data in order to do this. So what this is called is OnSign restrictions, and probably all the viewers that are listening are familiar with this literature. And it's usually done with aggregate data. And when you have aggregate data, in order to pin down the actual size of the shocks, you need additional restrictions besides just whether the slope is positive or negative to get the magnitude of the shocks. So you'd either have to pin down the actual slope of the supply and demand curve. A lot of papers pin down, they will actually make an assumption about the timing, how long the shock actually lasts using impulse response functions. So in this study, I'm going to just keep with the most simple, the simple assumption that you can, which is just that the slope of the supply curve is positive and the slope of the demand curve is negative. But what I'm going to do is I'm going to aggregate these binary indicators. So whether a supply shock or a demand shock occurred in that sector, that's what I mean by a binary indicator. And I'm going to aggregate over that information each month using the same weights that the BEA uses to aggregate up those same categories to generate PCE inflation. So I'll explain more in detail in a bit. But what this does is it gives you a continuous measure of the magnitude of the shocks, because when you aggregate binary information with weights, you get a continuous measure as opposed to just binary information about whether a shock occurred or not. Okay, so the data that I'm going to be using is the publicly available underlying price and quantity data that is produced by the BEA. So the US is one of the few countries that actually produces a quantity index at this disaggregated level, which allows you to do this. So what I'm going to go down to is the fourth level. You can go even further, but it just appeared that I'm going even further. I've done other studies, and this doesn't really gain you that much traction, and then it could create some noise as well. So by a fourth level, I mean, so you start at the topmost level, which is services, for instance, then you go to transportation services, which is the sub-level, and then a public transportation, and then, for instance, air transportation. So I'll be looking at the prices and quantities of air transportation would be one of the 136 categories in the PC price index that I'll be looking at. And then I'm also going to be looking at core PC inflation, which removes about 12 categories, which are in the food and oil sectors. And this data at the granular level is available back to 1988. I wish it went back further so we could explore what happened in the 1970s using this methodology, but it just doesn't exist, unfortunately. So it's a very basic methodology using sign restrictions. And I'm going to use just a simple reduced form of regression in order to back out what the surprises are, or the residuals here, these V's. So it's just a regression of the top equation is the log quantity index. The bottom equation is the log price index on 12 lags of itself and 12 lags of the quantity. So this is just a simple bar. And then these V's are the residuals. So these are the surprises to the log quantity index and the log price index. And then with those, we can use those to get the sign restrictions, or just the binary indicators of whether at least a supply shock occurred or at least a demand shock occurred. So if the residuals are of opposite sign, if the price and quantity residuals are of opposite signs, then I know that at least a supply shock occurred. A demand shock may have occurred or not. You're just not able to tell with this identification framework. And then the same is true if the residuals are of the same sign. I know a demand shock occurred. And then what I do with these indicator functions, or these are actually just a label. So for instance, I as a sector here, or a category, let's say that it's airlines, then I know that in month T, that airlines experienced at least a supply shock. So I'm going to put a supply driven label on that. And then used cars, for instance, may have had an opposite label, may have had a demand driven. So I'm going to put a demand driven label on that. So then all I'm doing is I'm separating out the different categories based on the labeling. And then I'm going to separate out, and then I'm going to aggregate up into the different contributions of the monthly inflation rate. And these are going to add back up into the published number by the BEA. So that gives you the monthly inflation rate. And then you can easily construct the 12-month rate by just doing a rolling sum of the monthly contributions. It gives you the 12-month inflation rate. And this is what the series looks like here. On the top panel is headline PC inflation. On the bottom is core. And you get some intuitive findings. You see that the demand contribution usually tends to fall in recessions. You can see in early 2001, for instance, there was a decline in a demand there that was actually stemming from the airline industry, which makes sense in hindsight due to 9/11. You see a strong decline in demand-driven inflation in the financial crisis. And then the supply-driven contributions actually tend to move around a lot with food and energy, which is what you'd expect as well. I think the easiest spot to see this is in around 2015. You see the red bars dip down there, and that's due to the negative the positive oil supply shocks that occurred then. And then, of course, when we look all the way to the right, is the inflation surge that we've been experiencing now. And the demand-driven contribution dipped down initially at the onset of the pandemic. Everybody was staying inside. There was nothing to demand. People were just sitting at home. And then, 8 to 12 months later was the reopening in the spring, and then demand just surged then. So you see the blue bars really shot up then. That was also at the same time with the American Rescue Plan, so it could be due to either of those two factors. And then what's interesting as well, too, in early 2022, with the invasion of Ukraine, you see a real surge in the supply-driven component, peaking in around June of last year, and then coming down again. So what's actually nice about this framework is that then we can look in and we can say, okay, how much of the contribution of the recent inflation surge was due to a demand and which was due to a supply? So what I'm doing here is I'm just looking at the excess inflation contribution relative to its pre-pandemic average. You can see here that the supply-driven component did surge in around mid-2022. It was contributing around 3.5 percentage points, and it has come down, which I think which is then I'm corroborating a lot of people's views about the supply chains easing, oil prices coming down. But I think what's interesting here too is that it's still the majority of the price or the excess inflation over its pre-pandemic average is due to the supply component. But that's not to say that demand isn't important either. It's still contributing one percentage point above its pre-pandemic average. And just looking at the individual categories, I thought was interesting too. You see some intuitive things going on here over the COVID period. Autos and SUVs, for instance, experienced excess supply shocks over this period. There was a lot of talk about the chip shortage, furniture as well, due to the shipping cost increasing. And then on the demand side, you see rent is a big player here, clothing, jewelry, and other types of products where like a reopening, going back to work, for instance, women's clothing, men's clothing, experience a demand shock. Okay, so I'm just going to as my final exercise here, it's more of a proof of concept, seeing how these different contributions move in response to shocks created by external researchers. So I'm going to look at two different types of shocks. One is a monetary policy shock. It's a high frequency identified shock. And then the other is an oil supply shock. And I'm just going to use a local projection framework, which is just an impulse response function, but in a more flexible, just a more flexible approach on these two shocks. And I'm going to look at what happens to inflation in the periods that follow. YT minus tau here are just a bunch of controls to control for pre-trends and also financial variables. So on the top here, this is both core inflation, so it's stripping out food and energy. What's interesting here, is you're getting the usual or the expected sign. So this is actually a shock to the slope of the interest rate path. So an increase in the slope causes a decrease in the demand contribution, and a slight increase in the supply contribution, which I thought that was interesting as well. There is a literature on the cost channel of a monetary policy, but it looks like overwhelmingly that the demand component is what's most affected by a monetary policy shock. And then when you look at an oil shock, you also get the expected signs that an increase in oil prices or a decrease in oil supply causes an increase to the supply contribution of PC inflation. And then interestingly, you get a decrease in the demand contribution, which has been discussed a lot in the literature. Increasing oil prices acts as like a wealth tax. People feel poor, or they have to substitute away to less expensive products. And then finally here, I just wanted to show something that I thought was interesting as well. So this is the same oil supply shock on headline inflation, which includes oil, and you get a much larger impact. It's almost 5 times the size of the core, which is what you'd expect as well. And then I got this kind of funny finding that it increased the demand contribution. So I thought, okay, well, what's going on here? Is this just a bug or something? And it turned out it was actually something real, that there's some substitution that actually goes on. So on the bottom right here is a fuel oil. You get the expected signs that the price goes up and the quantity goes down of a fuel oil, but then there's some substitution going on, that people, when the price of oil goes up, that they increase their demand for other fuels. So you see on the blue line on the bottom left panel here, an increase in the quantity purchased. So I'm just going to sum up and say thank you. And also all these series are publicly available, and they're updated on a monthly basis. So this next Friday, or this upcoming Friday with the PCE release, will be updated and available to download for everyone to use. Thank you.
Thank you, Adam. Our next speaker for today is Chengcheng Jia. She's a research economist at the Federal Reserve Bank of Cleveland. And today she will be talking about average inflation targeting, time inconsistency, and intentional ambiguity.
Hello, hi, sorry. Do you see my screen now?
Yes, we can.
Okay, yeah. Okay, thank you. Thank you very much for having me here, and very happy to share my research. The title of the research is Average Inflation Targeting and Ambiguous Communication. Okay, so well, let me begin by saying that, of course, the views are completely mine and not necessarily those of the Federal Reserve Bank of Cleveland or the Board of Governors of the Fed system. So in this paper, we study the Fed's new policy of average inflation targeting. And our focus is on the communication side.
Chengcheng,
Yes.
We cannot actually see your slides.
Oh, okay. 1 second.
I think that they're up now.
Okay. Okay, yeah. What about now? Now it's
Yes,
fine.
we're good now.
Okay.
Yep.
Sorry, I had 2 screens. Okay, so we focus on the communication side. So as many people might have noticed, that the Federal Reserve hasn't been very clear about some implementation details of the average inflation targeting policy. And specifically, the Fed hasn't announced exactly over how many periods that it targets inflation to be averaged at 2%. So we're going to show that there are 2 possible motives for such ambiguous communication. One is the flexibility motive. And to show this point, we demonstrate that this average inflation targeting policy is time inconsistent, meaning that the central bank has the incentive to announce its intention to do average inflation targeting ex ante. However, ex post, when expectations have been formed, it wants to implement inflation targeting policy. And then what we show is that the time inconsistency nature of AIT leads to ambiguous communication about the horizon. And specifically, the central bank wants to say average inflation targeting of different horizons at different points in time, depending on the state of the economy. And this time inconsistency and this intention to communicate different horizons at different points in times leads to another question, is that if the central bank implements such communication strategy, will the private sector figure out? So we analyze this question by modeling that private sector learns the true policy through social dynamics. So this is a performance-based learning, so that people change expectations by comparing with each other's forecasting performance. What we find is that compared to clear communication of exact horizon, ambiguous communication delivers a larger following, a larger population of people who believe in this AIT policy. Okay. So let me be more specific of the model, and to concentrate on the intuition, let me begin by two-period AIT, meaning the central bank's objective function is a weighted sum of squared average inflation over 2 periods, and of course also a weight on the output gap volatility. The central bank wants to maximize its objective subject to the conventional forward-looking Phillips curve. And then we solve the equilibrium. The equilibrium is given as follows. So first thing to notice is that inflation and output gap are path dependent. It depends on one period lagged inflation. And the second thing to notice is that the coefficients of lagged inflation is negative, meaning that if yesterday or T-1 inflation is positive, then in absence of any shocks, in absence of any further shocks, today inflation will be negative, and also output gap will be negative. Okay, so let me now show you what this equilibrium will does to the Phillips curve, which is the constraint of the central bank's optimization problem. So to begin with, the Phillips curve in its structural form doesn't change. Current inflation depends a forward-looking component of expected inflation in the next period, and then depends on the demand, the output gap, and a cost push shock. To focus on the intuition, let's think of the cost push shock, UT, is a temporary shock. So let's first consider what happens under inflation targeting. Now, inflation targeting with temporary shocks, then people expect next period inflation to be at the target. So the deviation will be 0. The first term beta expected inflation in the next period will be 0. So when there is a temporary shock today, cost push shock UT is positive, that brings up inflation. What the central bank can do, it has to do is to tighten policy, and the higher interest rate will bring down demand, meaning a negative output gap, and that reduces current inflation. That's the only thing the central bank can do under inflation targeting. Next, let's consider average inflation targeting, and that leads to a second channel of the policy, which we call the expectation channel. And that is when in the current period, cost push shock UT is up, meaning current inflation is up, and then people in the private sector expect next period inflation, which negatively correlates with current inflation, is negative. So expected future inflation is negative, and that brings down current inflation. So that's the expectation channel. What this expectation channel does is that it makes the reduced form of Phillips curve yields a better available trade-off than inflation targeting. I'm going to illustrate that with this graph. So let's first look at the left panel. So that illustrates what happens after a positive UT shock, a positive cost push shock. So on the y-axis is inflation, and on the x-axis is the output gap. So of course, the best scenario is the origin, which is the dual stabilization point. Output gap is 0 and inflation is 0. However, there is a cost push shock today, meaning that if the central bank doesn't do anything, inflation will go up. And then those two straight lines, black and blue, are the Phillips curve. Let's first consider this black Phillips curve, which is the Phillips curve under inflation targeting. Compared to this Phillips curve, the one that is under average inflation targeting is closer to the origin, meaning that it has a smaller slope and a smaller intercept. So this one is better. But what does it to the equilibrium? How the central bank chooses the equilibrium? The central bank will choose the equilibrium to maximize its objective function. Under inflation targeting, the central bank's objective function is to maximize the current welfare, which I denote as the curve, dotted curve here, the period welfare, under this constraint. So the central bank chooses the equilibrium that is tangent between this Phillips curve and the welfare curve. However, under average inflation targeting, the central bank's objective function is different from maximizing the current period social welfare. And if the central bank committed to implementing the equilibrium under average inflation targeting, it will choose this blue diamond point. Now, since the expectations have been formed, so the Phillips curve is fixed now, the central bank has the incentive to maximize current period welfare by deviating to this red point. And the difference between the red point and the blue diamond is the time inconsistency. The central bank wants to deviate from its announced equilibrium by choosing a point that maximizes the welfare in this current period. This time inconsistency problem probably will be also applies to the case when there's no cost push up today, but lagged inflation is positive, which I demonstrate on the right panel. So on the right panel, what it shows is that because current cost push up is 0, so both of the Phillips curve crosses the origin here, meaning that dual stabilization is available to the central bank. And indeed, this is what the central bank does under inflation targeting, and will have 0 inflation, 0 output gap. However, if the central bank is committed to implementing average inflation targeting, because past inflation is positive, meaning that a central bank in this period will implement an equilibrium that has negative output gap and negative inflation. So this blue diamond point is of course worse than the dual stabilization point. And the central bank has the incentive to deviate from here and implement this dual stabilization point. So that shows the time inconsistency. Okay, conditional on this time inconsistency nature, that central bank always wants to do inflation targeting to maximize social welfare once expectations are formed. And then we compare, we think of this next question. What is the optimal horizon? And we found that it's state dependent. So we calculate the Phillips curve for multi-period average inflation targeting. What we found is that after a positive cost push shock today, a longer horizon will reduce the deviation in the current period that is due to the cost push shock. However, once the shock has dissipated, a shorter horizon will reduce further deviations due to lagged inflation. So depending on the state of the economy, the central bank wants to announce different horizons. So that gives the flexibility motive for ambiguous communication, meaning that a central bank wants to say average inflation targeting ex ante, but do inflation targeting ex post. And the central bank wants to announce a larger horizon once the shock hits the economy, and then deviates and then tends to a smaller horizon to minimize future deviations. So the central bank can announce one policy framework. So, and that means the central bank wants to ambiguously announce the horizon. So that leads to another question. Is that how about when the private sector learns over the years? And we study this question by modeling learning in the private sector through social dynamics. We have between group heterogeneity, meaning that people differ from each other by the beliefs about the horizon of AIT. Within the same group, people also have different observation errors of the shocks, that we call it uncertainty about the underlying shocks. And then people opted their beliefs about the horizon via tournament selection, meaning that they compare their forecast errors, and the winners keep to their beliefs, and then the losers will change the beliefs to the one that winners has. And also there's random mutation. We also assume that central banks knows everything, especially knows the fraction of people who are in different groups. What we compare is that we first think of a clear communication. The central bank clearly announced the average inflation policy is 2-period, 3-period, or 4-period. What we show is that by announcing two-period AIT, that has the largest fraction of people who believe in this AIT policy. Well, this y-axis I forgot to say is the fraction of people who believe the central bank's AIT policy. It starts from 1, meaning that everyone believes the central bank does average inflation targeting, and then people can change their beliefs over time. We see that announcing two-period AIT gains the largest following. What is interesting is that we consider another situation where the central bank doesn't announce exactly over how many periods. And we assume that people are equally divided to believe in the AIT policy has 2-period, 3-period, or 4-period horizon. What we see is that ambiguous communication gains the largest following compared to any of these 3 cases under clear communication. Okay, and then what we compare is the welfare. The welfare, what we plot here is the relative welfare to the ambiguous communication case. So by construction, ambiguous communication has 0 welfare loss. And then, of course, because this is welfare loss, so a smaller number means better. What we see is that this the purple ones that represents 4-period AIT and a clear communication is the best one, the lowest welfare loss, but only in the very beginning few periods. And then as time goes on, and then ambiguous communication is the best one, has the lowest welfare loss. The intuition is that in the very beginning, when everyone believes in AIT, because the longest horizon gives the best Phillips curve. So that leads to the best welfare in terms of welfare. However, over the long run, announcing 4-period AIT will quickly lose the followings. People will quickly figure out that the central bank is not doing 4-period AIT. So, and that makes the welfare to reduce over time. Okay, so let me conclude here. We study the communication strategy for AIT. We find that AIT policy is time inconsistent, and this nature leads to ambiguous communication that brings to the maximized long-run welfare. Okay, thank you.
Thank you, Chengcheng. I think that we're ready to get started with the Q&A session. So before we do so, let me kindly remind all the attendees that they can, post all of their questions or comments for our 2 speakers in the Q&A space, and then I'll pick and choose questions for the speakers. So we have a question first for Adam. How should I interpret the supply-driven portion of inflation being usually positive? Does this mean that supply constraints are usually binding, or that supply shocks are usually slowing growth?
Okay, yeah, that's a great question. So the answer is no. So what I'm doing here is I'm looking at the surprise change in either prices or quantities. So you could have a sector or a category, I should say, that had a positive supply shock, which would put downward pressure on prices, but it wouldn't make it go negative. It would just be less than what was expected. So you would have basically a smaller red bar than what would be expected otherwise. So in the working paper, I invite you to go look in the working paper, and I actually plot the shocks over time, and it looks like they're more or less 50-50 when you look at the category level. When you weight them, I think it does tilt towards more negative supply shocks. Hope that answers the question.
Thank you. Let me get to a question for Chengcheng. Does it matter how you model average inflation targeting? For instance, what if average inflation targeting included both past inflation terms, but also expected future inflation terms? Would this matter for the outcome of your paper?
Well, yes. Well, what matters is that we have to include lagged inflation so that the inflation is path dependent, the equilibrium is path dependent, so that current inflation matters when you form expectation of next period. So without lagged inflation in the central bank's objective function, and then the central bank cannot change expected future inflation. So the expectation channel won't matter.
Thank you. Let me get back to Adam with another comment and actually two questions. So the comment says, nice idea presentation. The first question is, if I understand correctly, your binary indicator ignores the magnitude of your estimated V's from the VAR. Might identification be improved if you weight big in absolute value, V's more than small ones, and or if you in effect downweight V's that are in fact statistically insignificant from zero?
Yes, so yeah, I actually do exactly that in the paper, which I didn't have time to show. There's all different ways to do that. The most simple way would just be to ignore the small V's, which I do. That's actually the version posted on the website does that, which I call it's the ambiguous region. So yeah, those are categories where I'm not sure exactly what happened, just because the V's are small. It could be that there's joint shocks happening as well, which I discuss in the paper, which I also didn't have time to get into. And then the other way to do it would just be to do a Bayesian estimation and then use that noise as weights. So you get a probability of whether a demand shock or a supply shock occurred. All these methods really didn't change the underlying patterns. They do change a little bit, obviously, when you change a lot of the parameters. It's going to move around, but I got correlations that were all well above like 85%. Mostly above 90% when you look at the underlying 12-month inflation rates. Yeah, and then your second question also, so the way I handle that, especially in the pandemic period, you're absolutely right, it is important. So when big shocks are occurring, that the parameters on the reduced form specification are going to be changing. So what I did is I did a rolling regression, and that was the original specification that I used, which is on the webpage as well. In the working paper, just to keep things more simple, I just used a fixed parameter setting. Yeah, so when you do the rolling window and the parameters are allowed to change, you do find that the effects diverge for volatile periods, is what you'd expect.
Thank you. Let me get to another question for Chengcheng. So what would happen if, say, the fraction of average inflation targeting believers that goes beyond for periods? So what would happen to that fraction under clear communication versus ambiguous communication? Or in other words, can the strategy of ambiguous communication work for longer periods of time? So in a sense, can you fool people for longer periods of time?
So we does focus on longer horizon. So in long term is the ambiguous communication wins over clear communication.
Okay. Let me get to maybe a final question for Adam. So inflation has been sort of under the spotlight, right? Given its recent surge, and it has been under, I mean, apart from inflation expectations, they have been under the spotlight as well. Are there any sort of lessons that we can draw from your paper in terms of theory for inflation expectation formation processes?
That's a great question. Yeah, so this paper doesn't touch on inflation expectations per se, but I've gotten this question multiple times. So I have thought about how inflation expectations kind of fit into this framework. And so I guess the way I think about it is that expectations are just what a household or a business or an investor, perhaps, when they're investing in the tips market, are expecting about future supply and demand shocks, but it's going into the pricing process now. So, so the way I would fold that in is that like an inflation expectation shock would either be a supply or demand shock would fit into this model, based upon if the firm thought that its prices, so if they thought oil prices were going to be rising in the future, then they might raise their price now, which would just bring forward an expected supply shock into the current period, and then likewise for a demand. But the actual process of how that happens is not explicitly modeled in the paper.
Thank you. And I think that we have reached 11:45. I'd like to thank very much our speakers, Adam and Chengcheng, for their great presentations and insights today. And I'd very much like to welcome everyone to register for our next webinar session, which will take place next Thursday at the same time. Thank you so much again, and hope to see you soon.
All right. Thanks for having me.